Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another Lessons in Valuation 2-minute drill subscriber request series. I've got a very interesting company today, probably one of my favorite stocks in the world. It represents the quintessential example of what I like to see in a business as an investor. The problem is, as a value investor, I rarely get the opportunity to invest in this stock. We're going to talk about Fiserv, which is a transaction and payment processing company. And by the way, in an era where a lot of payment processors are undervalued, Fiserv has been bucking the trend by being a stock that has been generally overvalued. Let's go ahead and take a look at it through the lens of FastGraphs. Now, first of all, as you can see, I've got a plotting of adjusted operating earnings up here. And this is about as perfect as a company will ever be. It doesn't pay a dividend. It's purely a growth stock. It's averaged about 15.5% growth. So I'm drawing the PE at the P equals growth rate, or 15.57 here, as my fair value line. All right. And you can see that even during COVID, the company had one miss. In fact, if you look at their analyst scorecard, they had one miss, and that was during COVID, but yet they still had a double-digit earnings growth rate. It was just a little flatter than their normal 15%. So when I put weekly closing stock prices on the graph, you can see that generally this company tracked its earnings growth very beautifully until, well, like we see with a lot of stocks, 2014 and 15 and 16, we start seeing stocks trend above their what I would call fair value line. Inevitably always come back to that line, but sometimes it took long periods of time before it did. And of course, in COVID, we did see this big drop. But this is a quintessential stock, almost perfect. It's triple B rated, has less than 50% debt, which I like, doesn't pay a dividend. But even though the stock has corrected rather significantly, it is still well above what I would consider to be the earnings justified valuation line. Now, the market has this penchant of valuing it at just under 20 times earnings. Now, it's fallen below that now. If I look at it from a standpoint of forecasting and look at the future, analysts still expect double-digit growth of about 16.5% going forward. And it's pretty well followed by over 35 analysts. And analysts have actually been maintaining their estimates or even slightly increasing them over time from the 6 months ago, 3 months ago, and previous estimate. And it's technically in our valuation corridor, but you would have to really see the company trade at a 20-ish multiple. Here I've drawn the line at a 21.34 multiple. So it has to trade at somewhere a 19 to 23 multiple to where you could get, I'd say, the rate of return that the company's business is capable of generating you. And that's a high valuation to pay. Okay, and it's currently 19.22, which would be this orange line right here. It's only got an earnings yield of 5.2%. If it traded at its correct PE, which would be 16.5, P equals growth rate using Peter Lynch's formula, it would be able to give you double-digit returns. So for the consistency this company offers, this correction may have brought it to a level where it would be at least worth looking at or investing in. Now, I would have rather bought it back in here in 2022 and so on when it got inexpensive again. Of course, the ideal time would have been to be buying it back here in 09, 010, when you could buy it under 15 times earnings. But it's a great company, extremely consistent grower. When you look at the analyst scorecard, I think it's important to point out it's been almost impeccable. The only miss they really had was during the COVID year, as I said, even for the 1 year forward, that's with a 10% margin of error. Their 2-year forward has been almost impeccably perfect. So it's really a very consistent company, and that's the kind of company, as I said, I really like, but I do like to buy them at a little better valuation than that. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, covering Fiserv here, one of my favorite stocks in the world. I think it's probably investable today just because of the quality and consistency of the company. But being a strict value investor, as yours truly is, I would like to see it a little cheaper before I put my money in it. But it's certainly a stock that I think over the years has proven its mettle, and as analysts are still expecting good things from it going forward. Thanks for watching. If you like the video, give me a like, ring the bell so you can get notified of future videos. Take a look at subscribing to FastGraphs, the value investor's best friend. It really gives you such a great perspective of the business behind the stock. And then, of course, subscribe to our YouTube channel for more videos like this. Thanks for watching.